groups. So, what can you buy with a self-directed retirement account? Or self-directed IRA, I should say, for this slide. Self-directed IRAs, you can buy anything other than collectibles, stock in a subchapter S, or life insurance contracts. So, real estate. The way the law works, if it's not specifically prohibited, is therefore allowed. So, is real estate prohibited? No, therefore it's allowed. You want to go buy paper, make loans. Are they prohibited? No, therefore they're allowed. So rarely is it a question of whether the investment qualifies. It's who you're transacting with and for whose benefit that's going to dictate whether you can or can't do something. If we talk about solo 401ks or 401k plans, their only restriction is collectibles. So they're even less rigid than IRAs are.
What do you mean by collectibles in that sense?
I'm sorry?
What do you mean define collectibles in that sense?
Well, coins, or maybe collector cars, or things that are they're collectibles, not necessarily investments. If you want to go buy gold, it's important that you deal with using your IRA. It's important that you work with a broker that's going to sell you an IRA compliant investment, because they're not all compliant. All right? So that's not very restrictive, is it? So if you want to go buy, let's say you're tired of the rain. Okay, we haven't had much rain lately, but let's say you're already tired of it. And you want to go buy a place in Palm Desert to retire into someday. Imagine this. So you've got a Roth IRA, and you take money, roll it in a self-directed account, go buy a house in the golf course in Palm Desert for $250,000, one that used to be $1 million. And 5 years from now, you take it out, and maybe it's gone back up to $750 or something like that. And you cannot use that property. You cannot use it at all until you've taken the property out as a distribution. But when you take that property out as a distribution, what's the tax? None. What are you attracted to? If it's a traditional IRA, you're going to pay tax on whatever the equity is in the property as a distribution. So what's the property worth? What's an appraisal these days? I mean, if you've got two minds working together to decide, I mean, I know you brokers are pulling hair out with appraisers these days, right? I mean, the bottom line is it's worth what people are going to pay for it. And if you've got a buyer and seller agreeing to a value, that's probably what it is. And the appraiser's just going to go on based upon what else is going on. And, I always give this example. My youngest brother's an MAI appraiser in Bend. He doesn't do houses. He just does big stuff. But, he laughs. You heard me say yesterday, he laughs because he says he knows he's done his job when nobody's too happy or too mad. It's really difficult. What's tough for him is when somebody wants to refi something, especially if they want to do a cash out refi, because what is it worth? And you start looking at, Pronghorn. I've got people, that had property in Pronghorn. They paid $500,000, $750,000 for a lot or more. And those things are worth, what are they worth today? 70? If you can sell it at 70. So it's a different situation. So
when would you pay tax?
You'd pay tax in the year. You'd pay tax in the year of none, never. So with a Roth, you never would. A traditional IRA,
right,
you're going to take the property out. If you took cash distribution, you've got a cash distribution, you've got tax exposure on whatever the cash is. If you take stocks out, you've got a stock quoted price that you're receiving an in-kind distribution, you've got tax exposure on whatever that stock is worth. The real estate's the exact same way. The real estate comes out, it is worth whatever it's been deemed to be worth, and you've got tax exposure.
In your name now,
yep.
Absolutely.
Instead of the custodian or instead of the checkbook IRA.
So what if I turn around and sell it?
Well, it doesn't matter if you go around. Your basis is going to be, that value at time of transfer. So it's going to be current market value when you receive it. That's what your income, your tax is going to be based on. You can turn around and sell the next day with no tax.
Capital gains?
No, you're paying. Remember my comment about not a huge proponent of retirement accounts for this type of stuff, for a real estate investment necessarily. But yeah, when you take the property out, if it's worth $500,000, you just took $500,000 in a distribution and you've got tax exposure, normal
But
income
why
tax
would you
on
want to take it out?
$500,000.
Why would you want to take it out?
Oh, I don't know.
I mean, if you
Well,
sold it,
yeah.
you just leave it in your IRA.
Yeah.
You don't need the money on it anyway.
You know, at some point you get to where you've got the
Well,
required minimum distributions.
Right, right.
Well, yeah.
I mean, you got, I mean, that's,
But if you sell it for 500 and the 500 goes into your
Plan,
account,
yeah.
and you decide you only want to pull out 50,000 or 100,000, that's all you're going to pay taxes on. So you
Correct.
pull out, right?
Yeah. But what's interesting, just from tax planning perspectives, if you take 100 in cash out, you're paying tax on 100 in cash. If you take a property out that's worth 100, is it worth 100? I mean, what's the custodians? There's not a standard policy established by the federal government on valuation on that asset. So that distribution, what is it worth? And that's where it's a tax planning issue. You need an appraisal done on it. Some custodians require an appraisal on that if you're going to take the entire property out in a single year. But if you took it out in 2 years, you don't have to have an appraisal done on it. So, you know, a broker's CMA can qualify if it's 2 different years. But, you know, that's just what I'm saying. There's different opportunities. And where we'll have a property that maybe is something, you know, in your comment about cash in there, you're going to take cash out probably, but we've got a client right now that under court order, they had a family property, big one that had been inherited, the siblings are fighting, the judge, they end up in court, and the judge finds out they can they can use self-directed money to go buy somebody out. They could use their accounts to make this deal happen. One of the family members had enough money to buy out all the siblings, so the judge says, hey, if this can be done, number one, you figure out, make sure it can be done. If it can be done, you have to do it. So that's what they ended up doing. Self-directing, bought all the other siblings out of this property, and now instead of taking cash distribution, they're taking the required minimum distribution as an interest in the property. And when we take a distribution of an interest in the property, we've got 2 choices. In their situation, it's a checkbook IRA, which we'll talk about in a few minutes. The distribution could be a tenancy in common interest in the property, so you're taking a fraction of that value, is now, instead of cash, you're receiving a piece of the property. Now you've got a deeded interest in that property. Or we can take membership interest in the LLC as the distribution, and we don't have to mess with the deed each year. So we can do things different ways. So you can take cash, you can take, in their case, they didn't want cash out, they want an interest in the property. So how do we do that? And that's a purely case-by-case choice. What's going to work best for the people that are doing it? What do they really want? And the main thing for you to know is you can do it. Right? So pitfalls, traps, and UBIT. So I just told you what you can invest in. Now we're going to tell you, where the restrictions are. Examples of prohibited transaction. By the way, a prohibited transaction with an IRA converts the entire account. You can take $10 out of your account to go buy a hamburger and sink the whole thing. Yeah. So when we're talking about a checkbook IRA, it's really important that you're diligent. I have a client that's setting up an account right now, and he's like, well, who can be managers of the LLC and signers on the account? I said, well, who do you want to have on there? Well, I want to be on there. I want my spouse on there. And I'm thinking my daughter. And I said, well, you just need to understand, anybody that's on there, they've got to be diligent what they're doing. They need to know that they cannot do these things. If they do, it's a problem. So 401ks, on the other hand, is a little different. 401k, just the money involved with the indiscretion, is kicked out of the retirement account. So that's a big difference. We're talking about IRAs or 401ks. So you cannot borrow money from the plan, cannot loan money to the plan. Selling property to the plan is not okay. Buying from the plan is not okay. Receiving unreasonable compensation for managing. Let's say you buy a rental house. This one, our legal people don't want to see any compensation for management. But there's an argument for that. Sweat equity is not considered okay on a property. So if you use your retirement account to go buy a rental house and you want to go work on it, you shouldn't. Which is really backwards. Because what does your work do to the value of the property? Should increase the value. So ultimately, what does that do for the federal government? Increases their tax revenue.
So you have to sub out all the work.
Yes. You should.
Yes.
People say, well, gee, I'm just going to do it. So all of a sudden you get audited. You're misfortunate enough to get audited. You get audited by somebody who's smart enough to know what they're doing, and they're going through the ledger for the checkbook, and they say, gee, I've got an invoice from Sherwin-Williams for 30 gallons of paint. What'd you do with it? Your answer is, my tenants painted the property. Whatever.
Yeah.
You didn't do it. Using it as security for a loan. So when we talk about loans for retirement accounts, they've got to be non-recourse loans. That loan's not attributable to your income, your credit, period. They cannot go after you in any way for a default. The only way the bank can be made whole in a default is for them to take the property. The property is a sole recourse for them, period. So you're not going to walk into a national bank and get that loan. I shouldn't say you're not going to. Likelihood is that you're not going to. We can talk about sources for those loans. What's been interesting to me is over the last few years, we've had a number of our 1031 clients coming through that their credit's been bruised up a little bit because of properties and things have been going on, and they've had a harder time in some ways getting loans than our IRA 401k clients, because that loan, like I said, is not attributable to their credit or their income. It's entirely based upon the value of the property and the income on the property. They do need to, the bank needs to be comfortable, needs to understand how they're going to be made whole if, for example, one of David's properties, if you've got a single tenant property and it's a big one, you can't, let's say the thing goes dark. Now you've got debt service at a large amount that's got to be paid. How long can you float that debt service? The debt service has to be covered by the plan. You can't personally write a check to cover that debt service. So the question is, how do you get money in there? You can make a contribution each year, but if you've got a regular IRA, like $5,000 a year, that's not going to do too much. A SEP IRA, maybe you can get up to $50,000 a year or so in it, but you have to look at it and say, okay, how are we going to cover these things in the event of a building going dark, and make sure that we have enough reserves there to take care of it. So you want to make sure you have enough money to make the initial purchase. You want to make sure you have enough money or access enough money to cover that unforeseen circumstance that you don't want to have. So you want to have reserves there. And if you get a loan, the banks are going to make sure that happens.
That would be included in all retained incomes.
Pardon?
Yes. Does that include all retained incomes and that kind of thing?
Yeah.
Okay.
Yeah, because you can't write a check personally to cover those things. Whatever the plan owns, the plan owns. The plan's responsible for, the plan gets the benefits of. It's not your property.
Right. So I'm assuming that there's very few banks that would even consider something like that.
There's more all the time, but yeah, you're right. There are a few.
And if you do find one, the interest rates aren't going to be 3.5% or 4%.
Well, you'd be surprised. We've got the last few transactions we've done have been market rate loans. They're lower loan to value. This is the reason. Pardon?
I would think they'd be higher because you'd have that more equity.
Lower loan to value.
Oh, I'm sorry.
Yeah. I just said it the opposite of what you were thinking.
Yeah.
Lower loan to value. Typically, they'd be higher interest rates, but lately they haven't been. The reason, you're talking about a bankruptcy remote entity, that the cash flow is coming in and the investor's short of making poor investments, they can't just spend the money. It goes back in the account. So, unlike, John down the street that is buying and selling stuff and, going to Vegas every so often, not this John, but, you don't have that problem. So, the banks are looking at it a little different. But right here, we've got Willamette Valley Bank that will do them. Zions Bank will do them. Banner Bank will do them. I've got 2 or 3 other banks right now. They're calling me up, wanting meetings, figuring out how to do it because they see the default rates as a tiny little bit of what a regular borrower typically is.
So when you say lower loan to value, 25, 50%?
You're going to see maybe 65% at the top, somewhere in there.
Interesting.
They're happier lower, but,
Yeah.
This bottom piece is okay, so right here, generally prohibited transactions, traditional IRA converts, that account, that's the first day of that year. So we talked about buying the property in the desert, converting it, so you can't use it in any way until you've pulled the property out as distribution. Some river house that you want to buy, can't do it. Your kids can't use it. So a disqualified party to your plan would be you, your spouse, your kids, grandkids, parents, grandparents, or any other legal entity you own a controlling interest in. You cannot transact with a disqualified party. Actually, I shouldn't say that. You can transact with, as in together, but you cannot transact between. If you and I were brothers, I could loan you money out of my plan, you could loan me money out of your plan, which is pretty wild to me. That's possible, but up or down it's not. My kid's going to school down at U of O next year. If I want to take my retirement plan to go buy a property down there for her to live in, I can't do that. Because she's a disqualified party to my plan. That would be a prohibited transaction. All right. So the last little bit here that we need to be aware of is UBIT, unrelated business income tax, or sometimes it'll be UBTI, unrelated business taxable income. So if we go out and buy a $500,000 investment property, and we get a 50% loan to value on that thing, half of what we make on that property is going to be subject to tax, because the government has said the equity we've given you is tax-deferred or tax-free entity, but this isn't your money. This other 50%, that's not your money. That's other people's money, and we want tax revenue on that. So you're going to have tax exposure on the income or gain attributable to it, and you're also going to be subject to taxes on the gain upon disposition of that property.
So this is an argument for just simply paying cash, all cash.
Well, yes and no. I tell people don't not do it because of it. Just factor that into the return. So if you talk to somebody, a Wall Street broker, a lot of times they'll say, well, if you take leverage away from real estate, it's, literally I've had two brokers, the same firm, verbatim that said, if you take leverage out of real estate, it's a bummer. I mean, okay, that doesn't come out of two just independent minds. I mean, that's a company statement somewhere. It's not true. I mean, it's just, you need to understand. If the return is justified, understanding what the tax exposure is going to be, do it. If it doesn't work, then don't. It definitely makes it more complicated. And if you talk to your CPA about it, he or she might be like, well, I don't know how to factor that, calculate that. So when we're talking about these accounts, we need people that understand what they're doing with it and going to minimize that actual tax. So it's something to be aware of. Now the bold at the bottom, solo 401k plans. So if you're a sole proprietor, like a real estate broker, for example, I think solo 401k plans are way better than IRAs. Higher contribution limits. You don't have as many restrictions on what you buy. You do the wrong thing, you pay tax on only the money involved with the indiscretion. You can borrow against the plan. But the biggest thing is you don't have UBIT on leverage. That's a big, big difference. All right? Costs of maintaining a 401k are greater. You got other filing requirements, but yeah, anyway, just somebody had a question? Started to ask? No? Okay. So, not a reason not to do it, just something to be aware of. So the return's going to make sense or it doesn't, and if it doesn't, don't do it. I just, especially in today's market, I have people that will buy too much in an exchange because they don't want to pay tax. Don't. Get what you want. Get the property that makes sense. Make the investment that works for you, and if there's a little exposure, there's a little exposure. I understand nobody wants to pay taxes, but sometimes, it's the right thing to do. And having a little exposure, if your return doubles and you lose a half of that additional half in taxes, you're still ahead. All right. So any questions on this? You can leverage real estate held by a retirement account. It's got to be a non-recourse loan. The sources for those loans are much fewer, but they're there. And you've got to be just aware of that UBIT on the leverage there. You cannot, if you want to go out and buy a property, you can buy a property jointly with your retirement account. You say, well, gee, if I buy it personally, then I can get that normal loan. No, because what would be happening? The plan's benefiting by your actions. That's a prohibited transaction. All right?
You may have already touched on this point, Dave, but if there were two parties, separate parties, can they go in and buy, let's say it was $1 million property, could they each put in $500,000 and buy that property?
Everybody in the room could buy something together. We could all buy this new item with qualified money and money out of our pocket. We can combine our retirement account with money out of our pocket to buy things. So what I said earlier, I corrected myself. I said, you know, between. We cannot transact between. I can't buy or sell, buy from or sell to my plan. But if I want to go buy something along with my plan, I can. All right? But the rules apply. Prohibited transaction rules apply. We need to be careful in everything is paid. If I go buy something along with my plan and let's say it's a rental house and I need a plumber. Plumber goes out and I just say, well, gee, I'm going to pay for it and then I'll, you know, be reimbursed by my plan. No, that's not okay. Never should there be a transaction between you and your plan. So, now that could be argued if we have a tenancy in common agreement that stipulates that you're managing the property. I still don't like it, but there could be a valid argument there. On the other hand, if we just both put money, if I and we're going to talk about checkbook IRAs in a few minutes, but if I do a checkbook IRA, I've got a limited liability company that my plan buys into and I personally buy into it. The LLC then makes all investments. Now everything goes in and out of an LLC. And that's what's great about checkbook IRAs, is just the flexibility that they offer. So